Silver didn't just break a barrier, silver exposed a pressure point, and the market had to react before the story got out. The conflict is simple. The headline price says rally, but the way silver is trading under the hood says tightness, positioning, and forced behavior. And those are the moves that don't politely unwind. Stay with me, because by the end, you'll have a clean 2-scenario roadmap for the next week or two. The handful of levels that matter, and one hidden detail most people ignore, that explains why this move got violent fast. And that's where the real pressure starts. Look at what just happened in real time. Silver punched through the psychological $90 handle, printed into the low 90s, then snapped back hard. An ugly, fast shakeout that tagged the mid-80s intraday before it rebounded. That is not normal profit-taking. That's the market briefly losing traction, liquidity thinning out, and someone getting forced to do something they didn't want to do. You can hear it in the tape even if you don't have level 2. The candles get wider, the dips stop drifting and start snapping, and the pullbacks don't feel like sellers calmly distributing. They feel like a vacuum opening and closing. But that's not the part that matters. The part that matters is what that kind of price action usually signals in metals. When a major barrier breaks, and the reaction is immediate and chaotic, you're not watching a crowd change its mind. You're watching market structure change its obligations. And silver is the kind of market where obligations are everything. Here is the uncomfortable truth that makes silver different from a lot of other risk assets. The price can be the last thing to tell the truth. The spread tells the truth first. The curve tells the truth first. The cost of time tells the truth first. Because silver isn't only traded by people trying to get rich on a chart. Silver is traded by participants who have to manage inventory, hedges, margin, delivery windows, and options books. When those gears slip, the price doesn't move because of a headline. The price moves because the plumbing force is buying or force is selling. And if you want to be on the right side of this, you have to think like the plumbing. Because if this one level breaks, the math changes. Now let's talk about the force that tries to deny a move like this. It's tempting to turn it into a cartoon. Don't. The first pushback in a breakout isn't a movie villain, it's risk management. It's dealers trying to stay hedged. It's funds trying to keep leverage under control. It's desks watching volatility spike and tightening limits. It's margin requirements, breathing down the neck of anyone leaning too hard. In other words, the suppression force is often just the cold, mechanical need to not blow up. And ironically, that need can amplify the move instead of stopping it. Here's why. When silver pops through a major level, the options market wakes up like an alarm. Calls that were out of the money suddenly become in the money. And dealers who sold those calls or are taking the other side of those trades can just sit there and hope. They hedge. They buy futures to stay delta neutral. That buying pushes price higher, which increases delta, which forces more buying. That loop is reflexive. It's not opinion, it's math. And when liquidity is thinner than normal, that math doesn't glide. It jumps. But here's the hidden twist. The options reflexivity is only half the story in silver. The more revealing half is what the physical market is quietly signaling at the same time. Everyone watches spot like it's a scoreboard. But the more honest signal is what the market is paying for immediacy, what it's paying to have silver now versus later. That's term structure. That's spreads. That's the premium on prompt metal. And when that stays tense while price is ripping, it's a clue that this isn't just speculative heat. It's availability stress. But that's not the part that matters either. What matters is the hidden detail almost nobody explains cleanly. Paper and physical don't fight in public. They fight in the calendar. They fight in delivery windows. They fight in the exchange mechanisms that let someone swap one form of exposure for another. And silver has been flashing those signals for a while. Think of silver as two overlapping markets wearing the same name tag. The first is paper silver. Futures, forwards, unallocated exposures, promises that can be created quickly. The second is physical silver, bars, coins, industrial feedstock, metal that has to be mined, refined, assayed, shipped, and delivered in specific forms. When paper demand surges, paper can expand. When physical demand surges, physical can't expand on command. It can only reprice. And that repricing doesn't always show up as a neat, steady climb. It shows up as tension in spreads, unusual demand for delivery, a scramble for the right kind of inventory, and a market that starts paying up for time. The next detail is what flips the whole setup. Inventory is not one thing. Stocks are not one thing. In metals, there's a brutal difference between silver that exists somewhere in the world and silver that is deliverable into the system that sets global reference prices. There was also a difference between silver that is registered for delivery and silver that is eligible but not actually offered. And there is a difference between metal that an S sitting in a vault unencumbered and metal that S allocated to products or already spoken for. This is why you can hear people say there's plenty of silver and still see a market behave like it's tight. Because tightness is about float. It's about what is free to move at the margin this week under these rules. And when that float is smaller than people assume, a breakout over a major barrier becomes more than a chart event. It becomes a negotiation over scarce immediacy. And that's where the real pressure starts. Now zoom back to what right now looks like. Spot is hovering around the low 90s after whipping through the $90 barrier, tagging into the low 90s, then ripping lower and rebounding. That is a market that is discovering where the forced buyers are and where the forced sellers are. And if you felt emotionally yanked around by that swing, good. That means you're human. But it also means you're exactly the kind of participant volatility is designed to harvest. Because the way a squeeze evolves is not a straight line. It's a series of shakes that punish impatience. The trend signal can be intact, and the tape can still try to scare you out of it. That's deliberate, even when it's not manipulation in the cartoon sense. It's simply how liquidity and stops interact when everyone is staring at the same levels. And yes, it happens more in silver because silver is thinner, more leveraged, and more reflexive than people admit. But here's the key. When silver breaks a major barrier and reacts fast, you don't ask, is the story bullish? You ask, who is forced to transact and when? Because that tells you what happens next week. Let's stack the proof. Mechanism first, then symptoms, then structure. Proof point number 1 is volatility itself. When implied volatility is elevated, it changes behavior across the system. Dealers hedge more aggressively, funds size down or de-risk, and margin becomes a weapon. High vol doesn't just reflect fear. It creates fragility. It creates the conditions where a $2 move is not a dip, but a risk event that forces liquidation. That's why silver can be right and still whip around violently. That's why you can have the correct thesis and still get emotionally and financially wrecked if you treat every candle like a verdict. But that's not the part that matters. The part that matters is what high vol does to dealers around big strikes. When prices near a cluster, think round numbers, think the big shiny levels like $90, $95, and the psychological magnet at $100. Dealer hedging flows become lumpy. They come in bursts. You can literally see it. Price drifts, then pops, stalls, then launches, dips, then snaps back. That's reflexivity. And it's strongest right after a barrier breaks, because everyone who was waiting for confirmation piles into the same side at the same time. Proof point number 2 is positioning. In silver, positioning is not a footnote. It's the battleground. When you get a violent move after a breakout, it often means some part of the market was leaning the other way at leverage, and now the collateral math is changing. Shorts don't close because they change their mind. Shorts close because their broker changes the terms. Their margin requirement rises. Their drawdown breaches limits. Their risk manager says, not here, not like this. That forced covering becomes buying pressure that doesn't care about value. It cares about survival. And forced buying is the kind of buying that can gap a market, especially into thin liquidity. That's the kind of move that makes the market react fast because it has to. Proof point number 3 is the physical investment complex. You don't need to romanticize coins and bars to understand the signal. You just need to notice what happens when investment products accumulate metal over time. They reduce free float. When vault holdings are increasingly allocated, spoken for, packaged, and not casually released, the marginal buyer has to pay more to pry metal loose. That can show up as persistent deficits, stock drawdowns, and stress in borrowing costs. And yes, in periods of tightness, you hear about borrowing costs, lease rates, spiking. That's not a meme. That's the price of temporarily obtaining metal, which tends to rise when available unencumbered metal is harder to source. It's a pressure gauge, but that's not the part that matters. The part that matters is what happens when the market tries to translate that physical tightness into paper pricing. This is where the hidden detail comes in. The exchange mechanisms that bridge futures exposure and physical settlement can become a highway when fear spikes. If more participants try to convert paper exposure into physical terms, if demand for that bridge surges, the bridge itself becomes congested. That's not just demand, that's structural stress. And when that stress rises at the same time as an upside barrier breaks, it creates a nasty combination. Speculative reflexivity plus real-world availability anxiety. That combo is what makes a breakout stick longer than people expect. Proof point number 4 is the curve. When a market is awash in supply, the forward curve is usually relaxed. When a market is tight in the prompt, you often see the nearby contracts behave differently than deferred contracts. You can see it in spreads. You can see it in the cost of rolling exposure. Even if you never trade, spreads directly, you should care, because spreads are the market's way of telling you whether this rally is being pulled forward by I need metal now versus I am betting on metal later. And now demand is the dangerous kind. It's the kind that rips. It's the kind that creates backwardation like tension. It's the kind that makes a paper market less comfortable because time stops being cheap. And when time stops being cheap, leverage stops being comfortable. Proof point number 5 is global cross-current behavior. Silver isn't only a US story, it's a global flow story. Different regions can exhibit different degrees of tightness. Different exchanges can show different appetite. When investor activity strengthens across major venues, it matters because it suggests the move isn't isolated to one pocket of speculative heat. And when a move becomes global, arbitrage becomes the stabilizer and the accelerator at the same time. Here is how. If one region S, prompt metal, becomes more valuable than another S, metal moves. But moving metal takes time. Shipping, assaying, refabrication, those are bottlenecks. So the price has to do the work while the metal catches up. Price becomes the courier. And that's where the real pressure starts. Now let's talk about why now. Because timing is the difference between a breakout that sticks and a breakout that gets erased. Right now, we are sitting in a calendar pocket that is perfect for ugly moves. A major psychological level has just been tagged. Volatility is high, and we're heading into a thin liquidity window around a long weekend in the US market participation changes around holidays. Liquidity is patchier. Moves travel farther on less volume. If you think gaps only happen in meme stocks, you haven't watched silver in a stressed regime. In a stressed regime, the gap risk is not a theory, it's a schedule. Because the calendar dictates when options expire, when futures roll, when delivery notice periods loom, and when funds rebalance exposure. Even without knowing every microdate, the principle is what matters. When timing pressure stacks on top of positioning pressure, the market stops being smooth. It becomes discontinuous. And if this one level breaks, the math changes. This is also where macro sneaks in. Silver is not purely a precious metal and not purely an industrial metal. It's a hybrid, and that makes it hypersensitive to regime shifts. Real rates, dollar strength, inflation expectations, and risk appetite all matter, but they matter differently depending on the week. In a week where silver is breaking a major barrier, macro becomes an accelerant, not a driver. Stronger dollar, hotter data, shifting rate cut expectations, those headlines can trigger a shake. But the shake doesn't automatically invalidate the structural story. Sometimes it just provides the liquidity event that lets trapped positioning unwind violently. That's what you just saw, a surge, then a sharp snap lower, then a rebound. It is the market testing how much forced buying is underneath and how much fragile leverage is on top. But that's not the part that matters. The part that matters is the map you build from it. So here's the mechanism explainer in plain language, because you deserve to know what you're actually watching. Start with options. When people buy calls, especially around big round numbers, they are buying convexity. If dealers are on the other side, they are short convexity. As price rises, the dealer's exposure becomes more sensitive. To stay hedged, dealers buy futures. That buying can push price up further, which forces more hedging. That loop can produce a gamma squeeze, but a gamma squeeze isn't magic. It's an imbalance in who is forced to transact, and it can flip. If price falls back through the strike cluster, the hedging flows can reverse. Dealers sell futures as delta drops. That can amplify the downside just as brutally as the upside. That is why the most dangerous moment is not the initial breakout. It is the first violent retrace after the breakout. Because that mostly assists where the market decides whether the move is being supported by real demand and strong hands, or whether it was mostly a reflexive options pulse that can unwind. And that key is the next detail that flips the whole setup. You can diagnose that decision by watching how price behaves around the broken barrier. If silver can hold the 90 zone on pullbacks, if it can retest and stabilize, then the breakout is being accepted. If it cannot, if it knifes back through and stays heavy, then that breakout was a liquidity event, not a regime shift. But acceptance doesn't mean no volatility. Acceptance often comes with brutal wicks, because the market has to clear out weak hands and rebuild positioning at a new level. That's why your job isn't to predict every candle. Your job is to define the few conditions that change the thesis. And that's where the real pressure starts. Now let's address the strongest counterpoints, because credibility isn't optimism. Credibility is acknowledging what can go wrong. Counterpoint 1, silver at these levels invites recycling and scrap supply response. Not instantly, but it invites it. High prices make marginal sources of silver more economic. Counterpoint 2, industrial demand is real, but it can face a substitution, delayed orders, or inventory drawdowns if buyers believe the price spike is temporary. Counterpoint 3, a strong dollar and higher real yields can compress precious metals temporarily, even in a structurally tight market, especially if risk assets are wobbling and funds need liquidity. Counterpoint 4, the market can front-run its own tightness. If too many participants pile in expecting a squeeze, the squeeze can happen fast and then unwind fast. Silver loves to punish consensus. It doesn't reward comfort. So what do you do with that? You don't panic, you build a two-scenario lens, and you stick to it like a checklist. Because volatility will try to emotionally manipulate you. It will tell you the rally is over when it's only testing support. It will tell you the rally is guaranteed when it's only stretching positioning. It will lure you into chasing green candles and dumping red ones. And if you obey those impulses, you will be the liquidity for someone else's discipline. That's the psychology shield. Recognize that your emotions are a signal, not an instruction. When you feel urgency, slow your decisions down. When you feel fear, zoom your time frame out. When you feel the need to do something right now, ask yourself, is this trend signal changing? Or is this noise designed to force reactive behavior? Because in a market like silver, noise is loud by design. And the next detail is what flips the whole setup. The professionals don't predict. They manage. They manage exposure relative to levels, volatility, and calendar risk. You can do the same without pretending you're a hedge fund. Here's the near-term roadmap, next week or two, without fantasy precision. Scenario 1 is the controlled pullback and retest. In this scenario, silver stays volatile but constructive. The market respects the $90 area as a pivot zone. You might see it dip into the high 80s, maybe even probe the upper 80s, but it finds buyers. It stabilizes. The curve and spreads don't completely relax. Options-driven volatility stays elevated but doesn't collapse. In this scenario, the move is being absorbed and accepted. The next upside test is a return toward the recent highs in the low 90s. And if price can reclaim and hold that zone, the next magnet becomes the mid-90s, then the psychological gravity of $100. But notice what I didn't say. I didn't say it goes in a straight line. In scenario 1, the market tries to shake you out multiple times. It does that because that S, how it transfers exposure from tourists to people who can hold through volatility. And that's where the real pressure starts. Scenario 2 is the continuation squeeze and gap risk. In this scenario, the pullbacks fail to provide relief because forced buying is still present. You see fast V-shaped recoveries. You see dips that barely breathe. You see price push back above the recent highs and start printing higher highs in a hurry. That's when the options reflexivity can reignite because the market re-enters those strike zones where dealer hedging becomes a tailwind. That ES also wins shorts who survived. The first surge realized the second surge is worse because now their collateral is already damaged and volatility is already elevated. That's when you get air pockets, gaps, and frantic moves that feel irrational because they are not driven by valuation. They are driven by obligation. And if this one level breaks, the math changes. So what confirms each scenario? Don't overcomplicate it. For scenario 1, you want to see the market defend the broken barrier. You want to see the $90 area act like a floor on closing basis, not just a wick. You want to see pullbacks get bought with urgency, but not with panic. You want to see silver stop making lower lows on the intraday dumps. You want to see stabilization after the shakeouts. For scenario 2, you want to see quick reclaims of the highs and follow through that doesn't immediately fade. You want to see the market ignore bad news and keep climbing anyway. That S often the hallmark of a squeeze. You want to see the upside accelerate when it should be tiring. And you want to see the market trade like it S short of offers, like it's S running out of willing sellers. But that's not the part that matters. The part that matters is what weakens or invalidates the setup. Here's the simple invalidation logic. If silver cannot hold the broken barrier and repeatedly accepts below it, meaning it breaks back under $90 and stays heavy with failed bounces and lower highs, then the breakout is not being accepted. At that point, the market can slide into a deeper reset. What would be the next line in the sand in that case? The recent violent low in the mid-80s becomes the key. If that breaks decisively, it tells you the forced selling wave is winning, at least short term, and the market may need more time to rebuild. That doesn't mean the bull case is dead forever. It means the near-term structure is damaged and the squeeze narrative needs to cool. This is why you don't marry a prediction. You date a setup. You keep your boundaries. And that's where the real pressure starts. Now let's talk about what most people will get wrong emotionally over the next week. First, they will treat every pullback as betrayal. They'll say, it was a fake out. They'll dump into the hole. Then the market will bounce and they'll chase. Second, they will anchor to the high print. It hit the low 90s, so it has to go back immediately. And when it doesn't, they'll get impatient and over-leverage. Third, they'll start consuming narrative as if narrative controls price. They'll hunt for someone to blame, someone to worship, some single headline that explains it. Meanwhile, the real drivers will be spreads, hedging, margin, and physical availability. The psychology shield is this. Your edge is not speed, your edge is structure. When you feel yourself getting pulled into the emotional tornado, come back to 3 questions. Did we break a major barrier? Yes, $90 was breached. Is the market accepting above it on retests? That's what we're watching. Are forced flows still likely given the volatility and positioning? Very possible. Everything else is commentary. But that's not the part that matters. The part that matters is what you watch next, because watching the right things builds trust in your own decisions. Watch how silver behaves around $90, not on a 1-minute chart, but on closing behavior and retest quality. Watch whether rebounds are sharp and decisive or slow and tired. Watch whether the market keeps producing violent wicks. Those can be clearing events, but repeated wicks without progress can also be distribution. Watch the relationship between silver and the dollar and real rates, but don't let macro headlines override the tape if the structure is acting like a squeeze. Watch for the calendar squeeze points, thin liquidity into a long weekend, the roll dynamics, and the way options gravity can pull price toward big strikes. And watch the hidden detail. Any sign that the physical side is still tense, borrowing costs, allocation pressure, demand for delivery, the sense that prompt metal is valued more than it should be in a relaxed market. You won't always get a clean public number in real time, but you'll see the footprint in how price behaves. Tight markets don't drift lower peacefully. They snap back, they refuse to stay down, they trade like a spring under tension. And that's where the real pressure starts. Now, let's anchor this to concrete levels without pretending we can forecast the exact path. Consider $90 the pivot. Above it, the market has a reason to keep testing higher because it has broken the psychological barrier and forced a repricing of risk. Below it, the market has to prove the breakout wasn't just a squeeze pulse. The recent highs in the low 90s are the next ceiling. A clean push through and hold above those highs increases the probability of the market going hunting. First for the mid-90s region, then for the big, loud magnet at $100. And yes, $100 matters, not because it's mystical, but because it's where positioning and options, open interest often concentrate. It's where dealers care. It's where funds care. It's where headlines scream. It's where everyone becomes emotional, which is exactly why it becomes a battlefield. But that's not the part that matters. The part that matters is how you manage yourself when that battlefield gets chaotic. If you're trading, you respect volatility. You size accordingly. You assume wicks will happen. You assume your stop can be hunted. You plan for that. If you're investing with a longer horizon, you separate trend from noise. Trend is the barrier break and acceptance. Noise is the violent intraday swing designed to punish reactive decisions. You don't have to be perfect. You just have to stop being the easiest target. Because volatility will be used against you. It will weaponize your need for certainty. It will tempt you into all or nothing thinking. It will get you to abandon your plan for a feeling. Don't do it. Here's the simplest way to stay sane. Treat this like a process, not a prophecy. If silver holds the pivot and reclaims highs, you lean towards scenario 2 risk, continuation, and squeeze potential, with the understanding that it can still whipsaw. If silver fails the pivot and can't reclaim it, you lean towards scenario 1 failing and a deeper reset, and you wait for structure to rebuild. And if you want the one metric that quietly governs everything in a move like this, it's not a headline. It's whether time is cheap or expensive in silver. When time becomes expensive, when the market pays up for immediacy, that's the signal that the squeeze risk is real, because it tells you participants don't just want exposure, they want it now. And now is the most dangerous word in markets. It's the word that forces behavior. It's the word that turns a chart into a stampede. And that's where the real pressure starts. So here's the payoff I promised. A next week checklist you can actually use. 1, track the $90 pivot like your anchor. 2, watch the retest quality. Sharp defenses are bullish, soggy bounces are a warning. 3, respect the recent swing low in the mid-80s as the short-term floor that, if broken decisively, changes the near-term structure. 4, if price reclaims and holds above the recent highs in the low 90s, expect the market to start sniffing around the mid-90s and the $100 magnet, and expect volatility to weaponize itself around that zone. 5, remember the 2 scenario lens, controlled pullback and retest versus continuation squeeze and gap risk. Your job isn't to guess which one should happen. Your job is to recognize which one is happening early and not get emotionally bullied off your plan. And finally, if you are the kind of person who wants to understand markets instead of just react to them, stay close to people who watch structure, spreads, hedging, inventories, and calendar pressure, not just vibes and headlines. That's the difference between being entertained by volatility and surviving it.